So today I'm going to go over what's an ETF. It basically stands for an exchange traded fund. What does that mean? So an exchange traded fund is basically, it's a pool of assets, which could be stocks or bonds or commodities, anything like that. One of the first ETFs, if you look at the S&P 500, they have something called SPY. And this is basically the ticker symbol that you would look up if you wanted to buy the stock. And this has a cost of about 0.09%. Now, why is that important? Well, that's important because this has 500 different companies within this one ETF, and you want to keep your costs very low. If you want to go a little lower, there's something VOO, and that's 0.03%. So these are two of the ETFs that Warren Buffett uses in Berkshire Hathaway. These are very low. It's a fraction of 1%. And what you want to do is try to keep your costs as low as possible. And some people will say, well, I want an actively managed fund because they'll outperform the market. In actuality, over 90% of actively managed funds do not even keep up with SPY or VOO, at least over a 20-year period. Now, in a given year, maybe like 20 or 30% outperform, but over the long run, especially if you're buying and just holding it for a long period of time, for me, I invest in these. This is not personal investment advice. All investments can lose value, and these are both exchange traded funds. These hold companies like Microsoft, Ford, Google, Amazon, Netflix, Tesla. Pick 500 of the top companies that are operating in the United States, and most likely they're in there. Some people argue about 20+% of this is just in the tech sector, but it has a lot of different companies in there. The benefit is you've already have a diversified pool of the 500 largest companies in the United States, so I don't have to go out and try to figure out which stock am I buying. I can just buy one ETF, and that one ETF within it has 500 different companies. So I would say if these are good enough for Warren Buffett and Berkshire Hathaway, they're probably good for most people. And they keep the cost very low. And remember, even the costs compound over time, and you don't want 2% to compound. So if you keep these very low, that means you keep a lot more of your money. And with over 90% of actively managed funds failing to even keep up with these, there's no real reason to pay those higher premiums. If you don't have a ton of time to invest in individual stocks, and even if you did, over 90% of you would fail. So you might as well just stick with an index, and it simplifies investing. So I do a lot of investing in Roth IRAs and traditional and Roth 401ks, and I buy a significant portion of the SP 500. So they might have SPY, they might have VOO. To me, it doesn't really matter. That's what I do. That's what Warren Buffett does, and I think he's pretty good at investing. So whenever I look at statistics like this, I'm not going to waste my money trying to look around for individual stocks. I know people that devote their life to it. Basically, over 90% of them fail, so I'm not even going to bother. So the S&P 500, if you reinvest dividends over the last 30 years, it's returned about 10.7% average returns. In 2022, it went down. In 2023, it went up 24.8% plus dividends of 1.4%. Overall, it comes out to this. If you want to think about inflation adjusted averages are probably closer to like 7%. If you want to become more financially educated, please subscribe. I'm going to cover a lot of topics on this channel, such as how do you make more money, how do you save money, how do you get out of debt, how do you use tax laws to your advantage. So there's a lot of great tax advantages if you know what you're doing. If you don't, it's going to cost you tens of thousands.